Imagine having like over 6,200 clients just standing outside your office.
Just an absolute massive crowd.
Yeah, and they are desperate for your product. I mean, they are waving billions of dollars in the air, basically begging you to take their money.
Which is a great problem to have usually.
Usually, yeah. But in this scenario, you physically cannot take a single dollar from them because you are waiting on like a delayed shipment of custom front door.
Oh, that is the worst.
Right. You have the product built, it's sitting right there, but you literally can't hand over the keys.
Yeah.
Welcome to this Talk Tickers edition of the Deep Dive. Today we are breaking down the Q2 2026 earnings call for, well, one of the most heavily scrutinized manufacturing giants on the planet.
The Boeing company.
Exactly, the Boeing company. And that scenario I just described, that's not like some hypothetical business school problem.
No, not at all. That is very real.
That is the exact reality Boeing is wrestling with right now. They are trying to execute on this staggering, record-breaking $715 billion backlog.
Yeah, that number is just hard to even wrap your head around.
It really is.
Yeah.
So our mission today is simple. We are going to cut through the Wall Street jargon and, look at the absolute mechanics of what is happening inside these factories.
Because it is a phenomenal case study, really, in this tension between corporate finance and physical manufacturing.
Totally.
I mean, if you are looking at Boeing's balance sheet right now, you are seeing a company that is fighting tooth and nail to prove it has finally returned to its 2018 glory days.
Which is the benchmark, right?
Exactly. In the aerospace industry, 2018 is the benchmark year everyone uses.
Because that was before, well, everything went wrong.
Right. That was before the major groundings. It was before the global supply chain completely fractured during the pandemic.
Yeah.
Back then, Boeing was a reliable, predictable cash machine. And the entire subtext of this Q2 earnings call is management trying to signal to retail investors and, institutional analysts alike that the foundation is finally rebuilt.
But reading through the transcript of this call, it feels incredibly murky.
Oh, yeah. Very murky.
It reads like a high-stakes thriller, honestly, where the company's trying to fix the engine of a plane while it is already at cruising altitude.
That is a very apt analogy.
Because you have top-line revenue looking great, right?
Yeah.
But underneath, there are these massive legacy anchors just dragging them down.
Definitely.
So let's start by looking at the headline numbers. The stuff that hit the news fees the second the market opened.
Big numbers.
Right. We saw revenue come in at $24.6 billion for the quarter, which is, a very solid 8% increase year over year.
And that 8% growth is a genuinely healthy signal.
Yeah.
Especially because you see it across all three of their main divisions.
Right. The three big pillars.
Exactly. You have Boeing commercial airplanes, the defense, space, and security segment, and then their global services division. All of them are showing that money is actively coming in the door.
Which is step one, right?
Right. Top line growth is the absolute first thing you want to see in a turnaround play. Okay.
But then you slide down the income statement. You get to the core EPS, the earnings per share.
The bottom line.
Yeah. And this came in at a loss of 76 cents per share.
Ouch.
Right. So officially, on paper, they are bleeding money.
They are.
Yet, and this is the dissonance that retail investors that you listening right now have to navigate. Their free cash flow came in at a positive $631 million.
Which is a big deal.
And it actually beat analyst expectations. So, okay, stop right there. How do we reconcile this? How do you have a negative earnings per share, but over $500 million in positive free cash flow?
It's confusing, right? But it really comes down to the fundamental difference between accrual accounting and actual cash movement.
Okay, break that down for us.
So earnings per share captures a lot of non-cash charges, things like depreciation or, anticipated future losses that are booked in the current quarter.
That's an accounting mechanism.
Exactly. It's on paper. But free cash flow, that is the actual oxygen of the business.
The real money.
Yes. It is the literal cash hitting Boeing's bank accounts minus the capital expenditures needed to maintain the business.
Got it.
And the reason the cash flow is positive right now is tied directly to the rhythm of commercial plane deliveries.
Oh?
When Boeing delivers a 737 or a 787 to an airline, that is the specific moment a massive final cash payment is triggered.
Because an airline doesn't just cut a check for $100 million up front when they order a plane, right? They pay in milestones.
They do, yeah. It's very staggered. They put down a deposit initially just to secure their slot in the backlog, which, by the way, right now stretches out for years.
Right. They just want to get in line.
Exactly. Then they make progress payments as the plane is actually being built in the factory.
Yeah.
But the lion's share of the cash, the massive balloon payment, that only changes hands at the very end.
Like at the dealership.
Basically. It happens when the airline's pilots physically inspect the aircraft, accept the keys, and fly it away from the delivery center.
So delivery is everything.
Delivery is cash. And Boeing delivered a high volume of commercial planes this quarter. Specifically, they delivered 129 of their 737s.
Wow.
So that influx of delivery payments is what drove that $631 million in positive cash flow. And was also bolstered by, the favorable timing of some customer receipts.
Which means the front door of the commercial business is wide open, right?
Yeah.
Cash is flowing in.
It is.
But that EPS loss tells us there is a massive leak somewhere else in the building.
A very big leak, yes.
So let's look at the Defense, Space, and Security segment, commonly referred to as BDS.
This is where the bleeding is concentrated.
Yeah, it really is. Because revenue for defense was actually up. It was up 13% to $7.5 billion this quarter.
Which sounds great on the surface.
Right, driven by volume in classified programs, missiles, weapons, the KC-46A tanker. But their operating margin was negative 0.2%.
Yeah. And the CFO, Jay Malev, provided a really vital piece of context on that margin during the call.
What did he say?
He pointed out that if you exclude just one single program charge, the defense segment would have hit a 3.5% positive margin.
Wait, one program dragged the whole segment negative?
Yes. They had to take a brutal $280 million charge on the VC-25B program.
Okay, for those who don't spend their days reading obscure military procurement documents, VC-25B is the new Air Force One.
Right.
It is the highly customized 747 built specifically for the President of the United States. And this $280 million loss stems from the fact that this is a fixed-price development contract.
And we really need to emphasize this. Fixed-price contracts are the toxic anchors dragging down Boeing's entire defense portfolio right now.
Let's unpack that. Why are they so toxic?
To understand why, we have to look at the historical mechanics of defense procurement.
Okay.
Historically, a lot of experimental or highly customized military programs were cost-plus contracts.
Plus, meaning what exactly?
Meaning, the government goes to a contractor and says, hey, we want you to build this crazy new technology. We know it's hard. We know things will go wrong. So we will cover whatever it costs you to develop it, plus a guaranteed percentage of profit on top.
Got it. So the government takes on all the financial risk.
Exactly. It shifts the risk to the taxpayer, but it ensures the defense contractor doesn't go completely bankrupt trying to invent something that's never been built before.
That makes sense. But the VC-25B, this new Air Force One, isn't cost plus.
No.
It's a fixed price contract that was negotiated years ago.
And that is the trap.
It's like, imagine quoting a client $50,000 to build a fully custom kitchen in their house. You sign the paperwork, everything is locked in. But then a global pandemic hits.
Right. The worst case scenario.
The global supply chain completely fractures. Suddenly, the price of lumber triples. The cost of copper wire doubles.
You can't find materials anywhere.
Exactly. You can't even find specialized electricians, so labor costs just skyrocket. But you still have a legal obligation to build that exact custom kitchen.
Yeah.
But now it costs you $100,000 in materials and labor to do it. You can't go back and ask the client for more money. You just have to build the kitchen and pay the $50,000 difference out of your own pocket.
That analogy perfectly isolates the mechanical trap Boeing is in right now.
It's brutal.
It is. They agreed to build 2 heavily modified 747s for a set locked-in price. But since that contract was signed, look at what happened. We have seen generational inflation.
Yeah.
We've seen a complete fracturing of the aerospace supply chain and massive, massive increases in aerospace engineering labor costs.
And it's not just building a normal plane, right?
Yeah.
The engineering hurdles on Air Force One are staggering.
Oh, absolutely.
Yeah.
It is not just a luxury jet with leather seats.
Right.
It has to be hardened against electromagnetic pulses. It requires mid-air refueling capabilities. And it has to have this incredibly secure communication suite so the president can run a global war from 40,000 feet.
So every single component is wildly complex. And during the call, CEO Kelly Ortberg explicitly stated this program is in a, quote, reach forward loss position.
Yes, a reach forward loss.
What exactly does that mean in Wall Street terms?
It's an accounting requirement. If management determines that a contract is ultimately going to lose money over its entire lifespan.
Like they know for sure it's a loser.
Right. They can't just recognize those losses slowly, piecemeal over the next few years as they actually happen.
Oh, real?
No. They are legally required to recognize the entirety of the anticipated future loss immediately, right now in the current quarter.
Wow. So they just take the whole hit all at once.
Exactly. That is what this $280 million charge is. It is Boeing looking at the remaining build and test schedule for Air Force One, doing the math, realizing the labor and material costs are going to exceed the fixed contract price by another $280 million, and just taking the hit up front.
That is painful. And Ortberg also mentioned a very specific engineering hurdle that's driving this cost. He said they are shifting from an FAA certification basis to a military certification basis.
Which is just a massive technical pivot.
Why is that such a big deal?
Well, initially, the plan was to heavily utilize commercial Federal Aviation Administration certification standards for the aircraft. Because the base plane is a commercial 747-8.
Right, it's a plane that already exists commercially.
Right. But as the modifications for the president became more and more complex, it became clear they needed to shift to a military certification basis.
And that's harder.
Much harder. The documentation, the testing protocols, the redundancy requirements for military certification are vastly more stringent and time-consuming.
Like you have to prove everything twice.
Basically, you have to prove that every single customized system won't interfere with the base flight systems. Changing the certification basis midstream requires an absolute army of engineers.
Just doing paperwork.
Redoing paperwork, rerunning tests, validating systems under a completely different regulatory framework. It just burns through cash and schedule margin incredibly rapidly.
So the ultimate takeaway for an investor looking at the defense side is that revenue is growing, but profitability is essentially being held hostage by these past mistakes.
Yes. These fixed price contracts are acting like an anchor.
However, in the Q&A portion of the call, Sheila Kayaoglu from Jefferies asked specifically about the trajectory of defense profitability from here. Like, when does this end?
Right, when does the bleeding stop? And Jay Malav responded that the 3.5% positive margin, which again, they would have hit without the Air Force One charge, that is the zone they expect to stay in for the balance of the year.
Okay, so low single digits.
Yeah. The long-term strategy for BDS is honestly just to burn through these painful legacy fixed-price contracts.
Just survive them.
Pretty much. As they deliver these problem programs and finally clear them off the books over the next few years, they expect to target high single-digit operating margins by the end of the decade.
So they're basically just waiting for the bad contracts to expire, so the newer, better-priced contracts can start shining through.
That's exactly it. The defense business is in a holding pattern of damage control right now.
Which means it places the entire burden of cash generation squarely on the shoulders of Boeing commercial airplanes.
Completely. The commercial side has to carry the company.
Right. So let's examine what actually drove those commercial results.
Yeah.
We know they delivered 129 of their 737s this quarter.
Yes.
But the number everyone was watching, like the absolute obsession of Wall Street analysts on this call, was the production rate.
Because the 737 is Boeing's primary cash cow.
The moneymaker.
It is the absolute workhorse of the global short to medium haul aviation fleet. And for the last few years, production rates have been severely depressed.
Right, due to regulatory scrutiny, factory quality escapes, and all those supply chain constraints we hear about.
Exactly.
But in this earnings call, management confirmed they are successfully ramping up to that magic number of 47 airplanes per month this summer on the 737 program.
That is a huge milestone.
And furthermore, they're opening their new Everett line to push toward 52 planes per month next year.
Right. And getting to 47 a month is critical because it proves that the physical factory in Renton, Washington is fundamentally healthy again.
47 is kind of the proof of concept.
It is. Building an airplane is this incredibly orchestrated ballet of physics and logistics. You have roughly 400,000 individual parts coming from suppliers all over the globe.
400,000 parts.
Yeah. And they all have to meet on the assembly line at the exact right moment. So pushing the rate to 47 a month means the supply chain is holding up, the mechanics on the floor have the tools they actually need, and the quality assurance inspectors are clearing the work efficiently.
And the CEO mentioned he was just in Everett right after the first fuselage loaded into the new production line.
Yeah, the new line is key.
To give some context on that for you listening, the 737 has historically been built exclusively at the Renton facility. But Renton physically maxes out around that mid-40s to 50 planes a month rate, right? They just run out of space.
Literally out of floor space.
So to get bigger, to hit the rates they need to satisfy that $715 billion backlog, Boeing had to find more room. So they converted a bay in their massive Everett facility.
Which is traditionally where they built the huge wide-body planes, like the 747 and the 777.
Right. They converted that to build the smaller, narrow-body 737.
And operating a new assembly line at a low initial rate, which is what they are doing in Everett, allows them to dial in the tooling. They can train the workforce and slowly ramp up the volume without stressing the core Renton factory.
It's like a pressure relief valve.
That's a perfect way to put it. If Renton can hum along at 47 a month, the Everett line gives them that incremental capacity to cross the 50-plane threshold. And that drive toward 52 per month next year is what unlocks massive cash flow.
Got it. Now, they also gave an update on the 787 Dreamliner, right? Their premier wide-body jet.
Yes, the long-haul jet.
They delivered 25 of them this quarter and successfully stabilized production at 8 per month. But the journey to get to that 8 per month rate exposes the absolute heartbeat of global manufacturing right now, which is the supply chain.
The aerospace supply chain is currently the most fragile ecosystem in global manufacturing, hands down.
It's just a mess everywhere.
It really is. And we have to look at the structural decisions Boeing made over the last 2 decades to understand why they are so vulnerable right now.
Okay, let's talk about the biggest structural shift they're making. Because they spent a significant amount of time on the call discussing the integration of Spirit Aerosystems.
Yes.
For context, Spirit is based in Wichita, Kansas. And they build the entire fuselage, like the main body, of the 777.
And this is where the history is just critical to understand the present. Boeing actually used to own those Wichita facilities.
They were Boeing factories.
Yes. They used to build their own fuselages. But back in 2005, following this massive trend in corporate finance to become, quote, asset light.
Oh, Wall Street loves asset light.
They love it. So Boeing spun off their Wichita operations to private equity, which eventually became Spirit Aerosystems.
So they outsourced the main body of their own plane.
Exactly. The idea was that Boeing would just be an integrator, let someone else handle the capital-intensive metal bending and all the heavy industrial work, and Boeing would just snap the pieces together in Renton and collect the high margins.
It worked on a spreadsheet for a while, I bet.
Oh, it looked great on paper for years.
But it fundamentally decoupled Boeing from the quality control of its most important structural component.
And that is the fatal flaw.
Because over the last few years, we have seen numerous quality escapes and manufacturing defects originating at the Spirit level that ended up completely bottlenecking Boeing's entire assembly line.
Right. Which brings us to the monumental reversal announced recently. Boeing is buying Spirit Aerosystems back.
They are bringing it home.
They are bringing fuselage manufacturing back in-house. And on the earnings call, Kelly Ortberg noted the integration planning is going well. But more importantly, Boeing has pledged a massive $1 billion investment to improve the Spirit facilities.
I have to stop and say that is an incredible admission of a past strategic error.
Oh, it's a huge mea culpa.
You spin off a division to save money. Right. It degrades over 20 years, causes all these problems, and then you have to buy it back and inject $1 billion of capital just to fix the manufacturing processes.
It's wild. But it is the necessary medicine.
Yeah.
Taking ownership allows Boeing to place their own engineers, their own quality assurance protocols, and their own capital directly into the Wichita factory.
They can't pass the buck anymore.
Exactly. They can no longer point fingers at a supplier. They own the fuselage from the moment the aluminum is cut.
Okay, so while the Spirit integration is a long-term fix, Boeing is fighting immediate daily supply chain fires that are literally leaving nearly finished airplanes sitting on the tarmac.
Every single day.
This brings us back to that analogy of the custom home waiting on the front door.
Yes.
We saw a bright spot in the quarter where Riyadh Air finally took delivery of their 787s. Those planes had been fully built, painted, and ready to fly. But they were sitting idle for months, simply waiting for passenger seats to be certified and delivered.
Just waiting for seats.
Waiting for chairs.
But, the seat certification issue highlights the immense complexity of commercial aviation.
Because it's not just a chair.
No, an airline seat is a highly engineered piece of safety equipment.
Right.
It has to withstand 16 Gs of force in a crash. The materials have to meet strict flammability standards, and it has to integrate perfectly with the aircraft's power and entertainment systems.
So if a seat supplier has a disruption in their own supply chain.
Right, in their sub-tier supply chain, say a shortage of aerospace-grade aluminum or specialized foam, the seats get delayed.
And Boeing can't do anything about it.
Boeing cannot legally deliver the airplane to the customer without seats. The FAA won't allow it.
So a $150 million asset just sits on the flight line doing nothing,
Trapping Boeing's cash.
all over a missing row of chairs.
It's incredibly frustrating for management.
I can imagine. And the seats are just one bottleneck.
Right.
The much larger, louder issue discussed on the call was engines.
Yes, the engines are the real pacing item.
During the Q&A session, Robert Stallard from Vertical Research pointed out a massive discrepancy. He noted that GE, which supplies engines for the 787, had recently stated publicly that there wasn't a problem with engine deliveries.
Right, GE was basically saying everything is fine on their end.
But Boeing's actions and their inventory of engineless gliders sitting outside the factory suggested a massive problem.
Yeah, you could just look at the factory and see there's a problem.
So how did management handle that?
Kelly Ortberg handled that tension very diplomatically but firmly. He stated unequivocally that Boeing has fallen behind on engine deliveries in the first half of the year for the 787 program.
So he called them out nicely.
Nicely, yes. He acknowledged they are working closely on a corrective action plan with GE. The reality is the engine manufacturers are dealing with their own immense supply chain constraints.
What are they short on?
Specifically, it's a shortage of forged metal parts and high-temperature alloys that are needed for the turbine blades.
Okay, so this shortage forced Boeing to make a decision that represents, I think, a fundamental culture shift for the company.
A huge shift.
Because of the missing parts, they actively chose to pause 787 production for several days in April.
They literally stopped the assembly line.
Just hit the big red button.
Exactly. And halting an aerospace assembly line is incredibly disruptive and extremely expensive.
I'm sure.
But it reveals a profound change in management philosophy. Historically, the pressure to maintain production flow at Boeing was immense.
Like whatever happens, keep moving.
Right. If a part was missing, even a major component, the factory would often just keep moving the airplane down the assembly line anyway.
Just leave a hole where the part goes.
Yep. They would just plan to install the missing part later, out of sequence.
Ah, this is called traveled work.
Right, exactly. And traveled work is the absolute enemy of aerospace quality.
Explain why it's so bad. Because it sounds like you're just putting it in later. What's the big deal?
Think about building a house. When a plane is at station 3 on the line, it is easy to install a bracket because the walls are open, the drywall isn't up yet.
Right.
But if you skip it and wait until the plane is at station 8, well, the walls are closed, the wiring is run, and the insulation is installed.
So you have to tear it all apart again.
Exactly. Now, a mechanic has to tear down a finished section of the plane, install the missing bracket in a cramped space, and put everything back together.
Which takes way more time.
It takes exponentially more labor hours. And crucially, it dramatically increases the risk of damaging something else or making a quality error.
So by stopping the line in April, Ortberg and his team chose to absorb the immediate financial pain of a delay to prevent the long-term cancer of traveled work.
That's perfectly said. They let the supply chain catch its breath.
They are prioritizing a healthy, synchronized supply chain and first-time quality over just blind speed.
Which takes immense nerve, especially when Wall Street analysts are screaming at you for cash flow every single quarter. But it is the only way to genuinely heal the factory. They only move the airplane forward now when the system is actually ready for it.
Which naturally leads to the question of whether they can actually achieve their future production targets.
Of course.
Christine Lewag from Morgan Stanley asked a very pointed question about this on the 737 program. She basically asked if Boeing is truly comfortable pushing the 737 rate to 52 planes a month, given these widespread supply chain constraints.
And Ortberg responded that he is comforted partially by Boeing's own buffer inventory of engines and by the delivery trajectory they're seeing from CFM.
CFM is the joint venture that supplies the engines for the 737, right?
Right. So he feels they have a solid, synchronized plan to get through 57 planes a month.
Okay, so they see a path to 57.
Yes. However, he admitted that as they look further out, pushing towards 63 planes a month in the future, the constraints will get significantly harder.
Because everyone has to scale up together.
Exactly. Every single supplier in the world, all those 400,000 parts, has to be capable of hitting that rate simultaneously.
Which feels like a tall order right now.
Very tall.
Let's shift gears slightly. This brings us to management guidance and what you, the retail investor, should expect for the future. For near-term cash flow, management maintained their full-year 2026 free cash flow outlook of $1 billion to $3 billion.
That is a very wide range.
The $2 billion spread.
Yeah, which really reflects the uncertainty of the supply chain we just talked about. But the key takeaway for investors is that they are maintaining positive cash generation for the year.
Digging into the quarterly cadence, CFO Jay Malav said they expect Q3 free cash flow to be positive, specifically in the low hundreds of millions.
Right.
And what is remarkable about this is that they expect to stay cash positive in Q3, despite having a massive $700 million DOJ payment scheduled for that exact quarter.
Yeah, that DOJ payment is a significant cash outflow. It's related to past regulatory settlements.
So it's not even related to building planes.
No, it's completely non-operational. And in corporate finance, absorbing a $700 million non-operational hit in a single quarter and still keeping your head above water.
That's impressive.
It is a testament to the sheer volume of cash that the commercial delivery ramp-up is starting to generate. It proves the underlying operational engine is producing real torque.
But, the near-term guidance is really just a stepping stone to the long-term holy grail.
The big number.
Management used this call to reiterate their absolute confidence in hitting $10 billion in free cash flow by the end of the decade. $10 billion.
If you are an institutional analyst or a retail investor holding this stock, that $10 billion figure is your North Star.
It's the whole reason you own it.
Exactly. Your entire valuation model is built around when and how Boeing achieves that metric.
But let's do the math on how they get there this year.
Yeah.
Because honestly, it raises a massive red flag.
Let's do it.
They're targeting $1 billion to $3 billion for the full year of 2026.
Yeah.
We know they generated $631 million in Q2.
Yeah.
They are guiding for the low hundreds of millions in Q3 because of that DOJ payment. Simple addition tells us that to even hit the low end of their yearly target, Q4 has to be an absolute monster quarter.
It really does. And Seth Seifman from JP Morgan did that exact math during the Q&A.
Did he call them out?
Oh, he challenged management directly. He pointed out that their guidance implies a remarkably strong fourth quarter just to offset the Q3 headwinds and hit the baseline targets.
So they need everything to go perfectly.
It requires flawless factory execution in the final 3 months of the year.
And banking on flawless execution in Q4 seems incredibly risky when there is a massive looming catalyst that could shut the entire company down in October.
Right. You are referring to the labor negotiations.
Yes.
Peter Arment from Baird brought this up. He noted that labor relations often get overlooked in these highly technical supply chain discussions.
Because people are so focused on parts.
Right. But labor is the foundational bedrock of production. If you don't have the people, you don't build the plane.
So let's talk about SPIA, the Society of Professional Engineering Employees in Aerospace.
A very powerful union.
Very powerful. They represent thousands of critical engineers and technical workers in the Puget Sound area. And their contract expires in October.
Right in the middle of this critical Q4 ramp up.
Exactly. And this isn't just about, factory workers turning wrenches.
No, not at all.
These are the engineers who resolve production issues on the fly. They sign off on design changes. They ensure regulatory compliance.
They hold the keys to the factory, basically.
Yes. If SPIA strikes, the factory cannot function. Production halts, deliveries stop, the cash stops coming in, and that massive Q4 they are banking on completely evaporates.
It just disappears. And Kelly Ortberg addressed this risk head on during the call.
He didn't try to sweep it under the rug?
He didn't downplay it at all. He explicitly mentioned that management has started early negotiations with SPIA.
Which is smart.
Very smart. The strategy is to begin discussions well ahead of the deadline to try to find common ground and avoid any kind of work stoppage. He characterized the tone of the talks so far as, quote, respectful and productive.
But he also admitted they are looking very hard at contingency plans.
Which tells you a lot.
Right. When a CEO talks about contingency plans for a union strike on a public earnings call, it means they are actively modeling out how many days of cash burn they can survive.
Yep. How to protect critical infrastructure.
And how to communicate a delay to those 6,200 waiting customers we talked about at the beginning.
It is prudent risk management. Ortberg noted that it takes two to tango in a negotiation. Management can want a deal all day long, but the union members have to actually ratify it.
Oh.
If those talks fail and the engineers walk out in October, that Q4 cash flow projection is in serious jeopardy. And by extension, the entire $1 billion to $3 billion yearly target is at risk.
This dynamic is exactly why you need to listen to these deep dives. A standard financial news ticker will just flash, Boeing maintains $1 to $3 billion cash flow guidance.
That's all you'll see.
Right. It won't mention the SPIA union risk, but that contract expiration is the fulcrum upon which the entire second half of Boeing's year rests.
It really is. But despite the risk, CFO Jay Malav vigorously defended their Q4 projections on the call.
Why is he so confident?
Well, he outlined 3 structural building blocks that give them confidence. First, the rising delivery rates on both the 737 and 787 naturally backload revenue into the end of the year.
So volumes is just naturally increasing.
Right. Second, they anticipate continued performance improvements and cost reductions in the defense segment.
Okay, burning off the bad contracts.
Exactly. And third, there is a seasonal cadence to their cash receipts. Specifically, massive advance payments they typically receive from the government for the KC-46 tanker program in the fourth quarter.
Government cash. That always helps.
Always helps the balance sheet.
Doug Harnett from Bernstein asked a fascinating question about the path back to the profit margins Boeing actually enjoyed in 2018.
Yes, the glory days.
Right. And Malav explained that as they increase the production rates, they get the massive benefit of fixed cost absorption.
This is a fundamental law of manufacturing economics. And it's so important for investors to grasp.
Give us the breakdown.
Imagine a massive factory building in Everett. The cost to heat the building, pay the security guards, maintain the tooling, and pay the core engineering staff.
All the overhead.
Right. All that overhead remains relatively constant, regardless of how many planes you actually build.
Okay.
So let's say those fixed costs are $100 million a month. If the factory only produces 10 airplanes in a month, each airplane has to carry $10 million of that fixed overhead.
Which destroys your profit margin.
Completely destroys it. But if you ramp production up and build 50 airplanes in that exact same factory...
Each airplane only carries $2 million of overhead.
Exactly. The plane suddenly becomes vastly more profitable without changing the price of the materials or the labor to build it.
So hitting 47 planes a month isn't just about delivering more product. It mathematically alters the profitability of every single plane rolling off the line.
Yes. Volume fixes margins. And furthermore, Malav noted they will be delivering better priced planes from their backlog as time goes on.
Because during the pandemic and the MAX groundings, Boeing had to offer significant concessions.
Massive discounts.
Just to keep airlines from walking away.
Favorable terms, reduced pricing, whatever it took to keep orders on the books during the darkest days.
But those planes are finally being built.
Right. As those older, heavily discounted legacy contracts are fulfilled and cycle out of the backlog, they are replaced by newer contracts that were negotiated recently in a much stronger pricing environment.
So it creates a dual engine for margin expansion.
Exactly. You have increased factory volume driving down costs on one side, combined with better pricing driving up revenue on the other.
Which brings us to the bottom line. After analyzing the revenue growth, the defense anchors, the supply chain bottlenecks, and the labor risks, we have to synthesize this into an actionable position for you, the retail investor.
The verdict.
Right. Our verdict today is cautiously bullish, but strictly for long-term holders.
I agree completely with that assessment. If you are looking for a quick 3-month swing trade here,
don't do it.
Do not do it. The near-term volatility from the Spirit integration, the DOJ payment, and the looming union negotiations make this incredibly dangerous in the short term.
But if your time horizon is measured in years,
then the structural thesis is definitely strengthening.
The core commercial business is humming. Proving that the Renton factory can physically achieve a rate of 47 planes a month on the 737 is a massive operational milestone.
It is undeniable proof.
Achieving the highest quarterly delivery total since 2018 is empirical evidence that the turnaround is not just a management talking point, right?
No, it is materializing in metal on the runway. The cash is literally hitting the bank account.
And we are also seeing tangible progress on their major engineering and certification hurdles. The foundation is demonstrably stronger than it was 2 years ago.
For instance, the certification programs for the final 2 variants of the 737 family.
The Dash 7 and Dash 10.
Right. The smaller 737-7 and the larger 737- are progressing steadily.
They mentioned on the call that testing is done on the Dash 7 and they expect an amended type certificate very soon. Now, can you explain what an amended type certificate actually is?
Sure. So in aerospace, a type certificate is the foundational regulatory approval that proves a new airplane design is safe to fly.
the ultimate green light.
Exactly. Getting a clean sheet type certificate for a brand new plane takes years of flight testing and billions of dollars.
But the 737-7 isn't brand new.
Right. It is a variant of the already certified 737 MX family. So Boeing applies for an amended type certificate.
Meaning they don't start from scratch.
Exactly. They only have to prove to the FAA that the specific differences, like the shorter fuselage or modified software, are safe, rather than recertifying the entire aerodynamic concept of the wing.
Got it. It's a faster process.
It is faster, but still incredibly rigorous. Management noted that all required testing for the Dash 7 is complete, and the paperwork is literally in the FAA's hands right now.
They also noted the Dash 10, the longest version of the 737, just completed its final test flight.
Yes.
And on the wide-body side, they are 55% of the way through the certification flight testing for the new 777X.
And flight testing for a massive twin-aisle plane like the 777X is just a monumental undertaking.
What does it involve?
It involves a whole fleet of test aircraft flying thousands of hours in extreme conditions, from the freezing weather of northern Canada to the high-altitude heat of Colorado.
Trying to break it, basically.
Basically. Proving out the engines, the new folding wingtips, and all the flight control software. Crossing the 55% completion mark provides investors with a much clearer timeline for when those massive jets will finally start delivering and generating cash.
So let's get to the actionable advice. If you are already holding the stock, the path to that $10 billion free cash flow target by the end of the decade looks more realistic mathematically and operationally than it has in years.
It's a solid formula driven by executing on that $715 billion backlog.
But if you were looking to start a new position right now, you need to watch two near-term catalysts like a hawk.
Very closely.
First, monitor any industry news regarding GE engine delivery recovery. If Boeing can't get engines, they cannot push the 787 rate to 10 planes a month.
That's a hard physical limit.
And second, set a calendar alert for those October SPIA union talks.
Those two factors will completely dictate the sentiment and the cash flow trajectory for the next 12 months.
Absolutely. However, there was one exchange during the Q&A that completely shifted how I view this company long term.
Oh, this was the highlight of the call for me.
It was so interesting. Ron Epstein from Bank of America asked an incredibly blunt, almost philosophical question.
Yeah, he really went for it.
He basically pointed out that the 737 airframe was originally designed in 1967.
1967. Think about that.
My parents were kids. The engine manufacturers have been innovating and iterating for 50 years to squeeze efficiency out of that same basic tube. And he essentially asked management, what about a new airplane?
Right.
Where is the next great aerospace leap from Boeing?
It is the question every aviation enthusiast wants answered. And Kelly Ortberg's response was, honestly, a masterclass in disciplined corporate strategy.
Even if it wasn't what people wanted to hear.
Right. Even if it wasn't what fans of flashy new technology wanted to hear. He stated plainly that there is no change in their strategy relative to launching a new airplane.
Meaning they aren't doing it.
Right. He noted that for a new clean sheet designed to be viable, three things must align.
What are they?
First, the market demand must be there. Second, the leap in propulsion or aerodynamic technology must be significant enough to justify the billions in development costs. And third, the company's internal engineering and manufacturing systems must actually be ready to handle it.
And right now, none of those three are aligned. Yeah.
Exactly, none of them. The engine technology for a true generational leap, like open rotor designs or hybrid electric propulsion, it just isn't mature yet.
It's still in the lab.
Yes. And internally, as we've discussed for the last hour, Boeing is still stabilizing their existing factories. Ortberg made it crystal clear they are not launching a new airplane anytime soon.
My immediate reaction to that was frustration.
I get that.
I'm thinking, are we just investing in a company that is squeezing every last drop of profit out of half-century-old aerodynamic designs rather than innovating? Isn't an aerospace company supposed to push the boundaries of physics?
As an engineer, it might be frustrating, but as an investor, it is exactly what you want to hear.
Really? Why?
For the rest of this decade, the investment thesis for Boeing is purely about execution, not risky R&D. Developing a new airplane costs roughly $15 to $20 billion.
Wow.
And it takes 10 years. It burns massive amounts of cash before a single plane is ever sold. Boeing doesn't need to invent a new plane right now. They have 6,200 commercial planes already sold and sitting in a backlog.
So the backlog itself is the moat?
Precisely. We have to look at the global duopoly. It is just Boeing and Airbus.
There is no one else.
There's no one else. If an airline is frustrated that Boeing isn't building a new plane or that their 737 is delayed by 3 years, they can't just go down the street and buy from someone else.
Right.
Airbus is also sold out for the rest of the decade, and they are dealing with their own immense supply chain and engine issues. The airlines are locked in.
So Ortberg is essentially saying, look, we have a guaranteed $715 billion of revenue waiting for us. We just need to build the plane safely and efficiently.
Yes. It is the ultimate execution play. It is not about the promise of tomorrow's unproven technology. It is about the gritty reality of mastering today's assembly line.
Innovation is expensive.
Very expensive. And right now, Boeing's mandate from its shareholders is cash generation, debt reduction, and operational stability.
That brings us to the end of our core analysis. We've mapped out the headline numbers, we've dug into the fixed-price defense traps, explored the factory physics of the 737 ramp, and highlighted the looming labor risks.
We covered a lot of ground.
It is a complex picture, defined by diagnostic muddy waters. But the underlying commercial demand is undeniably robust.
Before we wrap up, I want to leave you with one final provocative thought that builds on that exact conversation about Boeing's future.
Okay, let's hear it.
During that same exchange with Ron Epstein about new airplanes, Kelly Ortberg dropped a massive hint about how Boeing views the entire aerospace ecosystem.
What did he say?
When asked about long-term profitability, Ortberg noted something really profound about where the money actually sits in aerospace.
Where does it sit?
He pointed out that currently, a disproportionate share of the overall industry profit margin is hoarded by the supply chain.
Like the part makers.
Yes, the engine makers like GE and Rolls-Royce, the massive Tier 1 parts suppliers. They hold incredible pricing power because they provide highly specialized proprietary technology.
And Boeing is just the integrator assembling the expensive pieces.
Right. And Ortberg said they aren't going to try to change that dynamic on the existing airplane programs. The contracts are signed, the supply chain is set, it is what it is. But he pointed to their next airplane, whenever that may be in the 2030s, as the generational opportunity to completely rewrite the rules.
How do you rewrite the rules of a global supply chain?
By changing the value chain. He stated they are spending a significant amount of strategic planning time looking at where the actual value is in an aircraft and how Boeing might participate in that value differently.
What does that look like in practice?
He heavily hinted at exploring new business models, different types of risk-sharing partnerships, and potentially a massive shift toward vertical integration.
Wait, like what they are doing by buying Spirit Aerosystems back, but applied to the entire aircraft?
Exactly. Imagine if Boeing decides they don't want to just buy landing gear or avionics systems from a supplier who takes a 20% profit margin.
Right.
What if Boeing decides to bring the design and manufacturing of the most profitable components in-house for their next clean sheet jet?
It would completely upend the global aerospace sector. The suppliers that currently rely on Boeing for their existence would suddenly find themselves competing against Boeing's own internal divisions.
Exactly. So as you digest all these earnings numbers, mull over this long-term question. What happens to the profitability of the entire global aerospace ecosystem if Boeing decides to completely rewrite the rules over the next decade?
That's a huge question.
It wouldn't just incrementally improve Boeing's margins. It would fundamentally disrupt the balance of power in aviation manufacturing.
That is the kind of massive tectonic shift that separates a quarterly trade from a generational investment thesis. Returning to that 2018 benchmark is comforting, but the future of Boeing is going to look radically different than its past. Navigating unions, supply chain shortages, and fixed-price defense contracts is the grueling reality of today.
But if they can execute...
If they execute on this backlog and rewrite the rules for the next generation of flight, the upside potential is absolutely astronomical.
It will be a fascinating decade to watch, that's for sure.
Thank you for joining us for this deep dive into Boeing's Q2 earnings. We will keep translating the Wall Street noise into actionable insights, and we will see you on the next deep dive.